What do SEBI's new reforms actually change for investors? When does portfolio overlap actually matter and when doesn't it? What are the real concerns in the new SEBI circular? What should investors actually do? What mutual funds can now do that they couldn't before? Hello and welcome to Investors Hangout, your weekly guide to making smarter investment decisions. This series is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Now, SEBI has announced some changes to mutual funds that will alter how your mutual fund portfolio looks like. Now, today we're going to decode SEBI's biggest reforms in decades. What it reveals, what it fixes, and what every investor, every mutual fund investor needs to do right now before 1st of April. To decode all of this, we have with us Dhirendra Kumar. Welcome, Dhirendra.
Thank you.
So, Dhirendra, this is one of the most radical reforms that SEBI has brought about in decades. Can you first of all explain what has actually changed for an investor?
One is that it has taken a very conceptual view of things to unclutter things, to clarify things by design itself. First is that the retirement and children funds are gone because retirement fund cannot be one unified retirement fund. And when it comes to mutual fund, one mutual fund will be run like a mutual fund for every investor. So if there is an investor who is choosing a retirement fund and he is 10 years away from retirement, he needs a different plan as compared to a person who is 30 years away from his retirement. The homogeneity which it enables, that it will follow asset allocation. So that is why SEBI has enabled a different set of fund, which is target maturity fund. Likewise, if I have a 5-year-old child and if I have a newborn and if I have a 10-year-old child, they will all get into college at different time, at a different gap. And I can't have the standard. And these children fund and retirement funds, they are standard hybrid allocation. So it required a slightly different degree. And any mutual fund in its open-end fund structure can be a retirement fund. You don't call it one. If you invest in a fund and you think that this is your child's education fund, be at it. It's your children fund. Second one was that we have seen proliferation of wide variety of sector funds and wide variety of thematic funds. Many a times launching a new fund comes with a storyline. Story strikes a chord with investor. Investors get attracted to something which is untested, unproven, but is a nice story to hear. Everybody likes a good story. And they invest in their fund in something which is untested, unproven, based on a tempting story. That now SEBI is getting very stringent about. That if you have a story, if you have a thematic fund, if you have anything, show us that it is different from the other one. If it is not substantially different from the mainstream fund that you already have, you can't launch it. Third is bringing some kind of style purity, or it's basically nomenclature, true to label. If you are doing something, say it explicitly. And exactly what do you mean? It's a flexi-cap fund, it's a multi-cap fund. Don't give it a fancy name. Don't give it a wealth builder. Don't give it something which could be connotation of or runs the small possibility of tempting an investor with a misleading name.
Now let's come to the overlap problem, because many investors, they believe that they're diversified, but you've been saying that they're not really diversified at all. So can you decode that?
Yeah, I would say that I need diversification. That is one of the primary benefit of investing in a mutual fund. Then I need to stagger my investments over time so that I'm able to average my market exposure over time and I don't run the risk of catching a market high. Then comes, if I'm diversifying by a new name, by a new category, I should not be misled into thinking that I'm diversifying, but I'm not. That is what it is trying to address. Because when I invest, there could be need for even investing in a fund. There could be a case where two funds look alike, but their performance could be very different. Because the investing instinct of two fund managers could be very different. A value fund manager and a growth fund manager can also have 60% common stocks. But when they bought it matters more. So I don't think it is all that mechanical in terms of just looking at the fund portfolio and saying that 80% is common. No, that 20% of that difference can make hell of a difference. Also, we have seen it. This, I think, is a little bit of overkill in the sense that I have seen funds which are the worst performing fund over the past 20 years, and the funds which are the best performing fund of the last 20 years. And if you look at their portfolio and look at their portfolio over time, they look alike. The only difference is when that fund manager buys and sells and how he acts on a day-to-day basis, what that is, because there is the turnover matters, selectivity matters, what you avoid matters. So I think we cannot really have a very mundane or a naive view of a mathematical or arithmetic approach to investments or comparing their portfolio. I think investors should be diversified. Investors should have large cap, mid cap, small cap. They should have diversification of style, which is multiple fund companies as their investments get bigger. They should not buy into unnecessary, the only issue which the SEBI changes is trying to address and meaningfully is that nobody should be misled into believing that he is diversifying while he is not, pretending to be very different while it is not. The underlying things based on the portfolio as and when it gets built up after investments, it should not be, it turns out to be the same fund run by the same fund manager, but it was talked as a very different thing. That is a consumption fund, it's a manufacturing fund. Maybe there will be one or two omissions, or there will be one or two things which will not be there, but substantially it looks so. SEBI is saying that differentiate is don't launch a new one.
Now let's come to what worries you in this new circular that changes a lot of things.
It's not a worrisome thing. Now we will have the rollout of new range of lifecycle fund for every fund company. So, we'll have a wide range to choose from. And then they will start incubating performance from here so that we start before you can judiciously or objectively decide which one to buy. The other is the sectoral debt fund. I don't know. SEBI and all regulators and government has been attempting to reactivate the debt market activity, but it has not happened. I don't know how it can happen, or will it be a risky avenue, because the whole idea of a mutual fund and more so debt where the risk averse investors are getting attracted, getting into a sectoral debt fund will be an added risk if it is coming from but we don't know. The whole country is changing and we are just seeing the revival or activation of the manufacturing sector. So people need debt, but I don't know who the customer will be. And more so in a country where we have the fixed income avenues which are available in the friendly neighborhood post office. You have the public provident fund, you have the national savings certificate, you have the senior citizen savings scheme. You have the first port of call, which is where people want all kind of affirmation, all kind of guaranteed return, and a handsome one. Provided to them for their on an income which they depend upon. It is very critical to their income needs in retirement. So let's see how it happens, because the sectoral debt fund, I really wonder that it'll start. So this life cycle funds are a gift from SEBI, and they could be useful thing. And SEBI has gone about specifying the overlap rules in an arithmetic way. So if you differentiate or you wind up, it has teeth. So that's a useful thing.
Now let's come to what should investors actually do. If an average investor needs 4 funds, how does someone figure out whether they're already there?
Choose the right kind of fund at the right time and have as few as possible always. And you don't have to wait for April 1. That happens to be a Fool's Day. But no, even for the wise people, you should conduct that. Sometimes you just need one fund. That is when you are getting started. And as I keep saying, that if you are getting started and if you are 45-year-old, never invested before, start with a hybrid fund. Start with an aggressive hybrid fund or a balanced advantage fund. That will be a steadier take on growth. You will not be upset. You will not be driven out of the market on the first decline. Once you have done it for 2-3 years, gotten used to it, then think of multi-cap fund or flexi-cap fund. They will take care of most of your needs. Till you need your money in 5 years' time, start preparing a little bit with your redemption. That is all that there to it. And the second rule, and this can be achieved with one fund to begin with, then 2 funds as it gets larger, because once you have something meaningful, then you should spread it over. So the way I will approach it is never sell a fund if I have chosen a good fund. I'll start with the aggressive hybrid fund. Or I'll start with a multi-cap fund, start with one. After 2 years, I'll start another one. And little larger amount than the previous one, carry on with this one, have another one. And then so that in another 2 years, they all become of equal value with my increased investment. The beauty of mutual fund is that you are not liable. Choosing a good fund has a payoff. You hold it and keep holding it. You are not paying any taxes. And so you started with one, you increase it to two, then you increase it to another two, and that is it. And then you start redeeming or putting money in, if at all, assuming somebody keeps doing it till he's 50 and he has accumulated sizable money in these 50 funds. Don't get rid of the fund even if it is not doing relatively well in 1 or 2 years' time, because some great funds, best of funds have a lean period. And the best of funds don't do well all the time. That is why you should not give up very quickly. Have some objective measure. Understand that the fund manager is there. He's following the rules that have translated into great long-term returns. And anyway, equity investing is a long-term bet on our economy, on the companies, and also on the fund manager. Give him some time. Lean patches may not be a wise thing. And once you do this till you're 40, 45, 50 or close, as you get closer to retirement, maybe start preparing, redeeming 2-3 years before your retirement. The money that you need in the first 5 years of your retirement. That way you will be completely de-risked. And the second thing that you can do after 5, 7, 10 years of investment is that when markets crumble, people get upset. And the first decline has the worst impact on your mind. Because if you are invested and it's steadily going up, and the first and declines are always very sharp. So that is very upsetting. So that is when you should start doing asset allocation. Have some money in fixed income so that you can rebalance it. That is all there to it. Thoughtful, wise investors, watching investors hang out, they know it by now that they need few funds. They need to choose their funds carefully. They have to be investing regularly, and they should prepare well before they need the money. To put money in stable assets. And once you have something sizable by your yardstick, and everybody's sizable could be different, then think in terms of having your fixed income allocation. Fixed income allocation, try and have it through hybrid fund. And that will enable you a mechanism that you don't have to do unnecessary transaction, pay capital gains tax and fix it.
You were talking about life cycle funds. It just struck me. How are they really different from NPS? And if one has to choose between the two, should one invest in both? Or if one has to choose between the two, which one should one go for?
Mutual fund is able to offer something like, with life cycle fund, it is able to provide what NPS was able to, and mutual fund was at a disadvantage. NPS in its structure, once you invest in any of the plans of NPS, you move from tier 2 to tier 1, or within the funds, it's a non-taxed transaction. In the shell of NPS, you can move your money and change your allocation, have a control on allocation, or you can change the life cycle plan anytime. And it has no tax impact. Mutual fund was unable to. And so this enables that. There are 2-3 distinct advantages, disadvantages. One is that NPS has a narrower universe, which will be little disadvantages for a very long term. I would imagine that somebody investing for 30 years should have 20%, 35% into small caps too. But here the investment universe is defined. Maybe it will gain flexibility, or it'll have greater flexibility. The cost advantage of NPS is still there, that it can be, there can't be anything superior in terms of cost compared to NPS. There is one small disadvantage, that you have this annuity of 20%, but now you don't have to necessarily buy an annuity. Now annuity can be deferred till you turn 75. Now annuity can only be 20%. And the interesting innovation that is happening at PFRDA with NPS will provide it greater flexibility. Now this creates an opportunity for mutual fund. They will be able to establish superior, they'll present a avenue which might turn out to be very compelling, because it is goal oriented. And retirement turns out to be the most important goal which a person aspires to have, a secure one. You just want to eliminate at any cost a situation where you are going to outlive your savings.
Right.
That could be a nightmare. These up to 6 life cycle funds and the target maturity funds, they will add a very interesting dimension to creating a customized, goal-oriented and a very important goal for mutual fund. We have to see how it evolves. And I think given the greater flexibility of investment mutual funds have, and particularly with these funds, it might turn out to be a very useful thing.
All right, well, that's all we have for you in today's episode. Keep watching the space for more information. Thanks for watching. Bye for now.